Today is Saturday, January 23rd. Saturday, yes, Saturday. We're doing a video on Saturday. Why are we doing that? Because it is earnings season and we have earnings videos coming up tomorrow. So we're doing this one tonight. And this is a post-market review for the stock market activities on Friday and an outlook for this upcoming week. And boy, what a day, what a week it was. But yesterday things got out of hand with the whole GameStop mania. The thing started as an innocent frenzy with some Robin Hoodians having fun on Reddit, on the WallStreetBets forum, pumping stocks higher, causing short squeezes, and that was all fun and games. But these morons committed a serious error by attracting unwanted attention and committing a serious crime. And now the game is going to change. And this is exactly what we needed to mark a market top. The action that we saw on Friday is very indicative that we are very close to a market top if we're not already there. And you saw a very bad closing for the indices during the last hour of trading on Friday. We will discuss all of these subjects, specifically what happened with GameStop and the ramifications after, during the headlines of the day segment. This is gonna be another epic show, so buckle up your seatbelts and here we go. The Dow Industrial Average closing in the red by 179.03 points, or a decline of 0.57%. The Nasdaq closing in the green by 12.15 points, or a gain of 0.09%. The S&P 500 closing in the red, down by 11.60 points, or a decline of 0.30%. Now what about the sector's performance on Friday? It was pathetic. We have some sectors that managed to close in the green, but yet it was a pathetic performance, so we're not going to give any medals. Needless to say, at number 1, healthcare, number 2, communication services, and at number 3, real estate. The laggards of the day, energy, financials, and basic materials. A lot of pain for the so-called inflationary trade due to the retreat in the US dollar throughout the week and the fact that we saw the 10-year Treasury yield being muted to flat throughout the week. All of these conditions create tailwinds for what? The de-inflationary trade. We're talking about technology, the high growth names. And to illustrate that for you, let's go on and review the sector's performances for the week. Leading the pack and capturing the gold medal, communication services, thanks to the performance of Netflix, Facebook, and Google. At number 2 for the silver medal, real estate. At number 3 for the bronze, technology. The laggards of the week, similar story with Friday, energy, materials, and financials. Of course, this was the outlook before the week even started. Last weekend, we talked about this exact scenario. We will see a softening in the inflationary trade due to a retreat from yields after the massive rally higher since the year started. And of course, we're going to face a lot of volatility here regarding the dollar index and yields, depending on the policy outcomes and announcements from the new Biden administration. Moving on to the futures market performance, let's see what happened on Friday. The dollar managed to bounce a little higher, and perhaps the short covering rally in the US dollar is not finished yet. Throughout the week, the dollar was weak to muted. Friday, it started rallying once again. And right away, you see crude oil declining lower. And of course, add to that some of the news regarding COVID. More lockdowns in China, in Europe. The virus is not over yet. And I have some very bad news for you here during the headlines of the day segment regarding a new variant of the virus, unfortunately. But I have to show you all the information in case this is the black swan event that will hit the market very, very hard. But you see crude oil declining on Friday. Likewise, we saw declines in metals, gold, silver, platinum, copper, palladium, all closing in the downside. Similar story for what? Grains, when we see the US dollar rallying even a tiny bit higher, and more bad news regarding the reopening of the economy globally, grains suffer. And we saw declines across the board, from soybean futures to corn, wheat, oats, canola. The only futures that managed to close in the green during Friday's session were rough rice. But what about softs? Lumber continues to rise higher. We have news regarding home sales during the headlines of the day segment, and the housing market remains very, very hot. Meanwhile, we saw declines for coffee, sugar, OJ, Cotton, Coca, all closing in the red during Friday's session. The only bright light here meets futures. Massive gains for live and feeder cattle, but the biggest winner of the day, lean hogs. So all the greedy piggies who are gambling on GameStop and other mania names, perhaps you want to take some of your gains and park them with your tribe in lean hogs futures, because these piggies are about to run really, really hot. Moving on to the big casino, the options market, and let's see what happened there. What a mess it was on Friday. Absolute mania. The volume has surged significantly, and the hottest table remains Apple with about 2.7 million contracts exchanging hands on Friday. Massive volume. There's no wonder why the stock managed to rally and close at all-time high. About 77% of the contracts traded for Apple on Friday were calls. Here it is. GameStop at number 2 with about 2 million contracts. Now pay attention here. The entire stock volume that was traded in the market on Friday was a little over 50 million shares. We have about 2 million shares in options alone. When you translate into notional value, GameStop traded about 200 million contracts on Friday via options alone. So they're trading non-existent volume because the notional value of the volume traded in options for GameStop exceeded the entire available float in the name to begin with. This is the insanity that we're living in the market today. And about 47% of those options traded for GameStop were calls. At number 3, Palantir with a little over 1.7 million contracts. About 74% of those were calls. And then we have NEO with a little over 1 million contracts. 77% of those were calls. We have Tesla, AMC. Notice that the market overall had a terrible day on Friday, with exception of these names that are been trading via the options gambling mania, meaning that these rallies in Palantir, NEO, Apple, GameStop, they're not based on investors looking to invest in these names. They're all moving mechanically due to the gamma squeeze phenomena. And we see a massive surge in volume via call options gambling. The person who is selling you those options, they have to buy the underlying stock as a hedge. So when you buy calls for GameStop, AMC, etc., the market maker who's selling you the call has to buy the stock as a hedge. And of course, they enjoy the ride higher as the stock continues to go up and up. And then at some point, they decide to pull the rug when these call options become very excessive, and most of them become in the money. Market makers pull the rug and crash the stock. Bumps and dumps. This is the jungle market. No watchdog, no regulations, nothing. It's a Wild West kind of market, but it is yet another characteristic of this bubble that we are living in today. And of course, this phenomena is known as gamma squeeze. That's different from a short squeeze. I'll explain short squeeze to you when we talk about GameStop during the headlines of the day segment. But for now, let's cover some unusual trades that took place in the options market during Friday's session. And here they are. Starting with Google, the ticker GOOGL, just in case you didn't know. And they are buying the 2,200 calls. Expiration date, April 16th. And remember that Google is reporting earnings next week. So this could be an earnings play. Somebody's being very bullish on the name, or somebody that owns Google and they're selling calls to raise some cash. We will see how Google does when they report earnings. But in this case, they're paying about $27 a piece to enter this trade, which translates to $2,700 per contract. And that brings the total all the way up to $14 million. Massive bet here for Google. And the expectation is that the name is going to rally over 16% by the expiration date of April 16th. And here it is. We saw a lot of activities for GameStop and Palantir in particular. I'm not going to cover all of them. I'll cover some of them. And here is the trade for GameStop. They're buying the 60 puts. And remember that GameStop is trading at all-time high, higher than any time in history, even when these game stores were actually hot and performing well before the whole digitalization of video games. Just to illustrate the mania for you. And this is not a bunch of young investors being bullish on GameStop. No, this is just done as a prank as a game, but that game is getting out of hand. But for now, let's cover this trade. The 60 puts, expiration date March 19th, and they are paying big bucks for it, 20 bucks a piece, bringing the total to about 7 million bucks. And the bet here that GameStop will decline over 8% by March 19th. And what about this trade for the ticker GSX? This is a Chinese remote education platform. And we saw the surge of COVID-19 cases in China and some lockdowns. So some traders made bullish bets on this name, and you saw GSX rallying significantly higher the last few days. But here was somebody betting that the tide will turn and we will see the name declining, because they're buying the 85 puts, expiration date April 16th, and they are paying 17 and 75 bucks a piece to enter this trade, bringing the total to about $4 million. And the expectation here is that GSX will decline over 8% by the expiration date of April 16th. What about this trade for Tesla? They're buying the 895 calls, expiration date this upcoming week, January 29th. So this is an earnings play. And of course, this is a trade. Somebody's buying, somebody else is selling. Somebody's making a bullish bet that Tesla would rally higher. Another person is saying, I own the shares. I'd like to raise some cash because I don't think that Tesla would rally that much after earnings. And in this case, they're paying about 17.5 bucks a piece to enter this trade, bringing the total to about $1.7 million. And the expectation here is that Tesla would rally at least over 6% after reporting earnings. And the earnings are coming out January 27th. Here's another interesting trade for the ticker LGND. This is for Legan Pharmaceutical, and they are buying the 135 puts. The name, of course, rallied higher on Friday. Somebody's picking a top here, and they're buying the 135 puts, expiration date March 19th, with expectation that the name will decline over 5% by then, and they are paying about 15 bucks to enter this trade, bringing the total to about $1.5 million. What about this trade for the ticker ENPH? This is a Canadian solar play, and the name has been rallying really hot on expectation of the friendly policy from the Biden administration regarding solar in general. Now, they bought the rumor before the election, they bought the fact after the elections, and now they're buying it once again after the inauguration. And it's getting really hot, and the name is becoming very bloated, very overvalued. Somebody here is picking a top by buying the 200 puts, expiration date February 19th. And they are paying about 13 bucks and 40 cents to enter this trade, bringing the total to about $2.5 million. And the expectation here is that the name will decline over 6% by then. Continuing with interesting trades that took place in the options market on Friday. And here is a trade for Palantir. Of course, this name has been rallying mechanically due to the gamma squeeze in the options market. It's one of the Robinhood's favorite names to gamble on. The mob on Reddit, they like this name. This is one of those meme stocks, if you're familiar with that terminology. But here is somebody saying that the game is over and the fun ride is about to end by buying the 28 puts, expiration date March 19th, and they are paying about $4 a piece to enter this trade. And the expectation is that Palantir will decline over 14% by then. They are buying these put options seriously because they're committing big bucks for it, about $13 million. Somebody's bidding $13 million. This name has reached the top and will decline significantly from where it is right now by March 19th. What about the ticker MGNI? This is for Magnet, and it's a platform, a software platform that a lot of streaming services are using. And the name, as you might have guessed, has been rallying significantly the last few days, and somebody here is betting that the rally has a lot more juice left in it, and they're buying the 50 calls, expiration date February 19th, with expectation that the name would rally over 25% by then, and they are paying $1.70 a piece to enter this trade, bringing the total to about $1.3 million. Continuing with interesting trades, what about this trade for Johnson & Johnson, the ticker GNG? This is a name that is reporting earnings this week, and we have not heard from them yet regarding the vaccine trial. So perhaps we're going to get more color regarding the results of the trial, and if they are positive, the name could rally higher. Therefore, somebody's making a bullish bet here, buying the 172.5 calls, expiration date March 19th, with expectation that the name would rally over 5.5% by then. They are paying $2 a piece to enter this trade, bringing the total to about $1 million. Here's another earnings play for Microsoft. They're making a bullish bet, buying the 275 calls, expiration date April 16th. Very interesting that they went a little further time-wise. And they are paying about $1.70 to enter this trade, bringing the total to about $1 million. And the expectation here is that Microsoft would rally over 22% by then. Of course, on the other side of the trade, somebody who owns Microsoft stock or market maker who's selling those calls with the expectation that Microsoft will never reach that price target by April 16th. But here's perhaps the most interesting trade for the day, because we don't see that kind of unusual activities anymore in VIX proxies. But here it is for the ticker VXX, and they are buying the 20 calls, expiration date April 16th. They're paying $2.30 a piece to enter this trade, bringing the total to about $1 million. And the expectation here is that the VXX would rally over 22% by then. I do support this trade. I'm expecting a surge in volatility in February and March. And now, moving on to the headlines that shape the day. Let's start with some macro news. Right away in the morning, we had the PMI numbers, the services PMI, the manufacturing PMI for the U.S. composites. And it rose to 58 in January versus 55.3 in December, so a big surge higher. And here it is, signaling a sharp expansion in business activity despite supply chain disruption. Factory production rose at the quickest pace for 77 months, with services also seeing a stronger upturn. Now, this is good news for the economy, but it also signaling a rise in inflation here in the U.S. The demand is rising higher, the supply has to keep up with that rise in demand. Why is this bad news for the stock market? Remember what I say pretty much every day in this show. The stock market has turned into, say it with me, a cocaine addict. What is the cocaine? Fiscal and monetary liquidity. Fiscal and monetary liquidity likely to hit the market more during bad times. Therefore, the market thrives during bad economic times and very negative, pessimistic news. But when the economy starts to recover and we start to see good news in the economy, fiscal and monetary support has to be pulled back to manage inflation. That is all bad for the stock market. That is a drug addict. And like any drug addict, when you remove the drug out of the picture, it will suffer a withdrawal. So don't be surprised if you see the market underperforming during a hot economy, or at least a recovering economy. But while we have good news, economically speaking, and an uptick in inflation in the USA, we're not seeing the same picture in other territories. For example, the United Kingdom PMI numbers were a disaster. And here it is, breaking UK PMIs absolutely plunged in January. Services flash PMI at 38.8, versus 49.4 in December, the manufacturing flash PMI at 52.9 versus 57.5 in December, and the composite flash PMI at 40.6 versus 50.4 in December. Absolute collapse there in the United Kingdom. And perhaps this slowdown in the UK will tamper inflation expectations, at least in the short term, leading to a retreat in treasury yields, and that would be a lifting of pressure from tech and growthy names, but it will be bad for the stock market overall because there are two sides to the rise in treasuries. One side is that treasuries rise as inflation expectations rise higher. The other side is that the yield curve steepens, leading to a rise in yields for longer end part of the yield curve. So a decline in yields will signal that the expectation for recovery, normalization, an uptick in inflation perhaps will take a break due to the bad news we just got from the UK. So this is what we're watching for this upcoming week. How will treasury yields react? If they go lower, you'll probably see declines in the overall stock market, specifically the inflationary trade, aka the cyclical trade, aka the reopening trade, whatever you want to call it. On Friday, we also got some news regarding the housing market. Here it is. Existing home sales rise unexpectedly in December. The National Realtor Association, they're not dead yet, reports sales of existing homes rose 0.7% last month to a seasonally adjusted annual rate of 6.76 million units. Sales were up 22% year over year. Economists had forecast sales would be 6.55 million. That is a decline. Instead, we got 6.76 million. Once again, the housing market remains very, very hot in bubble territory, and the inflation here in the US is very, very evident. More on housing data. Sales of previously owned homes rose in 2020 to the highest level in 14 years as low interest rates and remote work during the pandemic boosted demand. So dumb money's chasing homes. What is smart money doing? What are the rich doing right now? Here it is. Sylvester Stallone's sprawling Beverly Hills estate hits the market for $130 million. I think that makes it the second most expensive property in the Los Angeles area. And of course, you look at the house, it's not worth anywhere near the $130 million asking price. But perhaps this is the sly premium, sly optimism. You gotta pay a little more for that. I might question here for the new stock market investor community. You guys have no clue how valuation works. And even if you did, you're not going to pay attention to it because in your head, valuations don't matter. Take a look at this home. The real value that is, it's about $40 million. But Sly is asking for $130 million. Ask yourself, are you dumb enough to buy this home and pay that premium? Of course not. Then why do you do the same stupidity when it comes to the stock market? Why do you pay to buy a piece for a company priced at $800 billion when the real value of the company is barely $60 billion? We're talking about Tesla, of course. But don't worry about Sly, because if the home doesn't sell, he'll be back with a better price. Oh, wait a minute. That's a different guy. Moving on, yet continuing with macro news. But this time around, we're talking about the godmother, Janet Yellen. And Janet Yellen has been changing her views as of late. And here is an example. Yellen is clearly open to higher taxes on wealthier Americans and corporations. Uh-oh, the game is coming to an end. What do you think higher taxes are going to do to corporate earnings? Shall we rally another 20 to 30% in the market on high taxes optimism? COVID. Moving on to COVID news, and perhaps this is going to be the black swan event that strikes the market out of nowhere. Matt Hancock, I guess this is the UK health minister, says South African variant could reduce vaccine efficacy by half. Wow. And here it is. The new COVID-19 variant identified in South Africa can evade the antibodies that attack it in treatments using blood plasma from previously recovered patients and may reduce the efficacy of the current line of vaccines, scientists said. Scientists have new biological evidence. The so-called South African coronavirus variant binds more readily and strongly to human cells, making it more infectious, top local epidemiologist Salim Abdul Karim said. And here it is from Dr. Fauci himself. Dr. Fauci said yesterday, we have not yet detected the South African coronavirus variant in the US, but quote-unquote, the level of comprehensive sequence surveillance thus far is not at the level we would have liked. And of course, they're saying here that Illumina is doing that surveillance. Illumina is doing the surveillance to find out whether the South African variant is already in the US or not. So what did the CEO of Illumina say? Here it is. Chances are high the South African COVID variant is in the US, Illumina CEO. Let me just say this. If this new variant can evade the current vaccines and the efficacy drops to 50, 40, 30%, we are heading for an unmitigated disaster, not just in markets, but in the economy overall. Moving on to market sentiment news, starting with this piece and this warning from Bank of America. Bank of America Corporation strategists warned the extreme rally on Wall Street that has pushed stocks to record highs, fueled by strong U.S. policy stimulus, is forming a bubble in asset prices. DC's policy bubble is fueling Wall Street's asset price bubble. Strategists led by Michael Hartnett wrote in a note on Friday, quote unquote, when those who want to stay rich start acting like those who want to get rich, it suggests a late-stage speculative blow-off. Bingo. When greed gets to this level, or even the so-called professionals become as greedy as the amateur retail investor, that is a sign to get the hell out of the market. The strategists predict a market correction and for positioning to peak in the first quarter, with the Bank of America bull and bear indicator closing in on a sell signal. We have covered news from Bill Ackman and Carl Icahn and the likes, positioning themselves for a massive correction in the market. We're talking 20% plus drop. Carl Icahn already bought a lot of puts, shorting a lot of stocks, expecting the drop to be very, very severe. Continuing with the piece from Bank of America. Soaring market prices as investors boost inflation-linked trades will drag quote-unquote Main Street inflation higher. There it is. Risking a taper tantrum, tighter financial conditions, and volatility events. The strategists warned. They highlighted past bubbles, including that of the dot-com era and the housing market crash in 2007-2008. The difference here is that the Federal Reserve has exhausted all of their tools, and what they want right now to recover the employment picture is a rise in inflation. A rise in inflation will lead to a rise in Treasury yields. A rise in Treasury yields, the risk-free rate, will make risky assets less and less attractive, meaning these high multiple names in the stock market will have to be cut because the so-called there is no alternative TINA will become less and less attractive as the time goes, just like when you and I were back in high school. TINA used to be hot, but as time went on, not so much. Continuing, risk assets rallying on vaccine prospects are getting fresh impetus this year from bets that a win for U.S. Democrats in the Senate will spur further fiscal stimulus, adding to Federal Reserve largesse. And it's pronounced largesse, not large ass. The S&P 500 index has surged more than 70% since its low last March, while the Nasdaq 100 has almost doubled and Bitcoin has soared above $30,000. Central bank balance sheets have ballooned in 2020, growing to a record size for the Fed and the European Central Bank. So I guess after all, the Federal Reserve balance sheet has a large ass indeed. Bank of America expects the Fed balance sheet to reach 42% of the U.S. gross domestic product this year, while predicting the country's budget deficit will hit 33% of GDP. What does that mean? Hello, higher taxes. When we talk about TINA, and there is no alternative to close this massive budget deficit without raising taxes. Any politician, Republican or Democrat, who's telling you that taxes are not going to go higher, they're lying to you. And here is more on market sentiment news. Warren Buffett's right-hand man has flagged, quote-unquote, a speculative frenzy in the stock market and bemoaned the lack of bargains. We're talking about who? We're talking about legendary investor Charlie Munger. And indeed, there are no bargains. I like to look for bargains. I cannot find any, even within the value stocks section of the market. Even value stocks are trading in la-la land these days. So what about retail traders? Are they listening to all of these warnings? Are they paying attention? Of course not, because they're indulged in this bubble. Here it is. Investors still flocking the most shorted stocks. 6M change of its highs, but at 82%, hovering near record levels, higher than the global financial crisis era. And here is the chart. All of a sudden, the most shorted stocks are the most attractive. Why is that? Number one, we have lazy investing behavior. What is lazy investing behavior? Oh, I like Peloton. I ride it every day. Everybody I know likes the Pelotons, so I'm going to invest in Peloton, regardless of the price. I don't even know what valuations are. All I know is I like my Peloton. Everybody I know likes the Pelotons, so I'm going to go ahead and buy the stock. Of course, Peloton is not one of the most shorted stocks, but I'm giving you an example. Reason number two, that this market has turned into a video game market. They're not buying stocks due to a genuine interest in buying a piece of the underlying company, but they're doing it for fun, for YOLO and memes, and they're looking for the most shorted stocks to buy in order to trigger a short covering squeeze and have fun about it, just like they're doing right now with GameStop. What else are retail investors buying beside the most shorted stocks and garbage stocks? Here it is. They're buying junk bonds. Yields on the riskiest U.S. junk bonds fall to an all-time low of 6.42%, Bloomberg Barclays data, because everybody's so comfortable with the fact that the Federal Reserve will buy these junk bonds out of their hands at a higher price. That theory is not proven yet. The Federal Reserve is giving you the promise, but when they see the prices at insane levels, the Federal Reserve, they're not stupid either. They're not going to buy. All of a sudden, these junk bond quote-unquote investors will find themselves standing alone with their pants down. And here it is, the panic euphoria model. This is one of the most reliable indicators in the stock market, historically speaking. And this time around, take a look at where we're reading in terms of euphoria. We are at all-time highs. More euphoric than the housing bubble, and certainly more euphoric than the dot-com bubble. This is insanity land, la la land, video game market. Pin the dumb, risky behavior and irresponsible activities in the stock market on the Federal Reserve. Because the argument here from these morons is, yeah, the market is euphoric, but so what? We got Papa Jerome. Papa Jerome is behind us. Let's see how Papa Jerome is going to stab you in the back. Because Papa Jerome is not responsible for your stupidity. He gave you a floor that the Federal Reserve will usher the tsunami of liquidity to help corporate America from failing and more job losses to flood the economy. But he's not responsible when you take the game out of whack. Market bubbles have to be corrected. Jerome is going to save your ass, but he's going to save it after the fact, meaning the crash will happen first and then the Federal Reserve will intervene to stop the bleeding. Who's going to benefit from that? Wall Street, not you retail traders, because all of what you're doing right now is gambling via call options. You're going all in, buying out of the money call options. When that slide happens, you got to lose everything. Jerome will rescue the market indeed, but he will rescue it after your dumbass gets flushed out of the market. Speaking of dumb, here it is. Retail volume in 2019 was 7 billion, 2020 10.9 billion, and now we're not even 1 month in 2021. We are at 14.7 billion. Double, more than double the volume in 2019. So when all of you geniuses keep telling me, oh, don't blame the Robin Hoodiots and retail traders for this mania. This is on Wall Street and the institutional investor. No. This is on retail investors, me and you. We are the dumbasses. When Wall Street dangles a lottery ticket in front of us, we go all in, handing them our cash, chasing the bubble higher and higher and higher. And then they pull the rug and we find ourselves with no pants, standing alone. And what are these retail traders buying? While attention focuses on big names like Tesla as a target of retail interest, Sansek believes that much of the real volume increase is coming from obscure names on the low end of the trading universe. There is a lot of volume in low price stocks, $2, $3, obscure stocks or volume have exploded. That tells me people are chasing momentum. They move because they start moving. People start talking about them in chat rooms and they move. I told you these Robin Hoodiots are like zombies high on meth. They're looking for the next score. They don't care what it is. Bankrupt company, non-existent company, doesn't matter. Give me a ticker. And I see that behavior from some viewers, unfortunately. Even though I made it clear that this channel is not gonna feed the frenzy. But some of the questions I get is pretty much summarized in, give me a ticker, give me a name, give me an options trade that I can buy. They scour social media, whether it's Snapchat, TikTok, Reddit, YouTube, looking for tickers in the morning. They find the ticker, they go all in Naruto style, heads first, buying these names. They don't even know what the underlying stock is, and it's all done via options. Here it is. There is still a phenomenal interest in options, particularly short-dated calls, he said. Those are options with the longest odds against the buyer because they decay so rapidly that they keep working as long as markets and individual stocks keep going up. They work until they don't. Simple as that. Very, very high risk taking for market participants these days. Options can be the easiest way for the poor to become rich if they're done correctly and with discipline. But it could be a recipe for disaster and 100% loss if it's done like this. It's working for now. There's gonna come a day, surprisingly, that strategy is not gonna work anymore. And here it is. When will this end? Sansik doesn't know, but looks for signs in another very speculative venture. While I never want to dismiss retail investors, there is a level of speculation that seems unsustainable, he said. When I look at Bitcoin potentially rolling over, that doesn't bode well, because I consider that bellwether for the speculative forever. Moving on to the main subject of the video, the whole GameStop fiasco. And before we start, let's address the terminology. A lot of you hear about shorting, short squeeze, short cover, and you're not familiar about what these terminologies actually mean. Let me simplify things for you. Let's say that you are bearish on a stock. You think a certain stock is going to go down. That stock is for company X, and it is now trading at $100 a share. You think that the stock is going to go down for whatever reason, and you want to make a bet against the name. What you do is you go to the bank, and you say, I want to borrow, say 100 shares of company X, which is trading at $100 right now. The bank says, okay, here is 100 shares of company X at $100. All in all, you just borrowed $10,000 from the bank. Let's say that things go your way and the stock declines 20% right away. For whatever reason. Now you'll say, all right, I want to cover my short. How do you cover your short? You return the shares that you borrowed from the bank, but you return them at the current price. So the stock was trading at $100 a share. Now it's trading at $80 a share. You return those shares to the bank, meaning that you return $8,000 to the bank and you get to keep the $2,000. This is why short selling is sexy. You don't have to risk any capital of your own, although you're going to have to keep a collateral minimum in case the trade doesn't go your way. At the same time, you get to keep the gains if the trade goes your way. And short selling is sexy for another reason. Stocks take time to go higher. They take the escalator higher, and then they take the elevator to the downside. I know we are in the upside down market, in the market currently, taking the elevator higher, but this is not how the stock market usually performs. In a normal market, we take the escalator higher, then we take the elevator lower. So the sudden crashes happen very fast, very quick, and therefore making short selling a very, very attractive phenomenon. Now, what happens if the trade doesn't go your way? Meaning you just borrowed 100 shares of company X trading at $100, all in all, $10,000. And what do you know? There's some good news about the company, whatever it is. And the stock rallies 20% instead of crashing 20%. What happens now? Well, you owe the bank the shares that you already borrowed, aka the $10,000, plus what the stock is trading at right now. It is trading at $120 instead of $100. So you owe the bank an additional $2,000. You're going to return the original shares that you borrowed, and you have to return another additional $2,000 from your own pocket. Usually that's not the case though, because what happens is the short sellers buy the stock at the new price instead. So instead of returning the $10,000, 100 shares of the name, and then another $2,000 from your pocket, the short seller would say, all right, maybe the stock is going to go higher, and my theory is wrong. So what am I going to do here is buy the stock, 100 shares at $120, and just pay $12,000 altogether and have a stake in the name. This is exactly what happened with Tesla stock, by the way. A lot of shorts covered their shorts and they bought Tesla stock, and then the stock kept going higher and higher and higher. All of a sudden, these former shorts are in love with Tesla because they're making money as the stock continues to go higher. In other words, Tesla is the house that shorts built via short covering. So I hope that the concept of short covering, short selling is now clear to you. There is an appeal to it. Hey, if the trade goes my way, I did not commit anything out of my pocket, and I get to keep the difference once I return the original shares to whoever I borrowed from. And if the trade doesn't go my way, guess what? I'm just going to buy the stock and go long the whole thing. But there is another side to short selling. There are people who short the stock, hedge funds, the trade doesn't go their way, and they continue holding the short position. The stock goes higher and higher and higher, and now they're racking up losses because at some point, they either have to buy the stock at the underlying price or they have to return those shares they borrowed plus the difference from where the stock is trading right now and where the trade was initiated. When shorts become too aggressive in a certain stock, shorting it over and over and over again, and they never take their gains, another phenomenon develops, the short covering squeeze risk, meaning in the case of GameStop, this stock was heavily shorted to the degree that the float was shorted more than there are outstanding shares for the company. And somebody, and that somebody will probably go to jail, by the way, figured out that with all of this frenzy and mania in the stock market, I could mechanically orchestrate a short squeeze rally in a name like GameStop if I can get enough people, enough retail traders to buy the stock and call options on GameStop with me at the same time. We can mechanically force a short covering squeeze in the name because as the stock continues to go higher and higher, when people buy it, guess what? These shorts have a stop loss order that will get triggered as the stock continues to rally higher and higher. And when that stop loss order gets triggered, what happens? They buy the underlying stock to cover for their shorts, and the buying intensifies and becomes a snowballing effect, and you see a massive run, just like we saw with GameStop. So I hope this is clear before we move and advance forward. Here it is. How chaotic Redditors made GameStop stock skyrocket and made short sellers cry. A quote-unquote short squeeze on GME stock has driven its price through the roof, and lots of Reddit gamblers seem to have gotten rich. GameStop is a company on the brink. In August 2020, its stock was in the toilet, trading at around $4 a share. Today, the stock is worth 10 times that amount. Of course, that's at the time when the article was released. Right now, it's more than 20 times. Much of that rise occurred last week. Why? A subreddit that describes itself as 4chan with a Bloomberg terminal is buying shares to drive up the price. The story of GameStop stock, which uses the ticker GME, has gone viral on Reddit and TikTok and in various finance communities. This is for good reason. The story is crazy, and lots of Redditors just got rich at the expense of institutional investors who had been betting on the company to fail. WallStreetBets is a subreddit filled with chaotic investment advice and surreal memes. In August, members of the subreddit began buying up shares in GameStop, and several offbeat investors started to tout the stock virtues. In general, GameStop has not been doing well. It's a brick-and-mortar store and a business that is increasingly moving to digital sales. It closed hundreds of stores in 2020 and owes almost $500 million in short and long-term debt. So essentially, people on WallStreetBets, along with several YouTube and TikTok investors, guessed as long as a year ago that if they bought shares of GameStop at a low price, the short sellers would eventually be forced to cover their shorts in mass, which would drive the price up. Most notable among these is a user named Deep Effin Value, who posted screenshots of them buying more than $50,000 worth of GameStop stock when it was valued at less than $1 in 2019. Deep effing value, who goes by the name Roaring Kitty on YouTube, predicted. This guy's an antique. Predicted back in August that GameStop stock would also skyrocket at some point, quote unquote. GameStop is one of the most compelling asymmetric opportunities today, they said in a video. GameStop is the most heavily shorted company on the market, he added in a video that largely discussed why he believed GameStop is a solid company, but also touched on the short squeeze possibility. In recent days, WallStreetBets users have been buying GME like crazy, at prices between $4 to $8. This increased buying activity, along with a not catastrophic earnings report and the installation of Ryan Cohen, the co-founder of Chewy.com, as a GameStop board member. Chewy is a stock market success story. Sent stock prices up, which likely spooked short sellers into cutting their losses on GameStop and caused them to cover their shorts before things get worse. Well, now the stock is trading at all-time highs, so you'll be dumb to cover you short at this point. What does that mean? The stock is about to crash once again. It's an ultimate shorting opportunity. Once again, thank you to the useful imbeciles at Reddit and the likes. None of this price move has anything to do with the fundamentals of the company, Carla said. It's all pure speculation. That means that after the squeeze is done, all of these guys will cash out. Be careful of this one, not all of them. There are going to be a lot of victims. Anyways, selling off the stock and causing it to fall back to earth, it is just froth. Once again, a shorting opportunity of a lifetime. These Redditors are handing you an opportunity of a lifetime. But let's move on to where things started to get really, really ugly. It was fun and games to begin with. However, you got to keep in mind, whoever decided to pump the stock on Reddit, that is criminal activity, specifically if they had an option position or stock position in the name ahead of time, and then they decided to pump. That is illegal, that is a crime, and the SEC will get them. That person or persons are going to jail 100%. But this is where things turn ugly. Very, very ugly. Reddit's angry mob. A backlash against Citron by some vocal Reddit users over its views on GameStop came to a head on Friday when the short seller said it will stop commenting on the stock following the actions of the quote-unquote angry mob. So what happened here? Citron's founder, Andrew Left, who's a famous short seller, went out and commented on GameStop saying that this is crazy and the stock is going down to $20. The mob on Reddit, the Robin Hoodie's mob on Reddit, decided to go to war with Citron Andrew Short, and they went in a frenzy buying the stock and buying call options like there is no tomorrow. And you see from them comments, they're buying more and more and more. And unfortunately, you see the comment right at the bottom there, guys, please hold. I got to pay off my student loans. Be careful, buddy, because next week you might owe a little more on top of your student loans if you're not going to cash out. And of course, the stock soared higher to the point where GameStop stock halts trading after Reddit drama. The stock suddenly rose 69% on Friday. They had to halt trading in the stock for volatility twice on Friday. And you see that the volume of GameStop stock surged to unprecedented level in history. It was absolute mania, absolute insanity, and then the mob on Reddit started attacking Andrew Left, not just harassing him online and hacking his accounts, but it went as far as threatening his spouse and children with violent crimes and sexual crimes. Things turned absolutely ugly and criminal, and this is where the line is drawn. That's the red line you're not going to cross and get away with. So here is what Andrew Left said. GameStop shares sprint higher after Citron abandons stock. Andrew Left, managing partner of short seller Citron, says it abandoned GameStop shares because of harassment from bulls on the retailer. And it went further. And here is a statement from Citron. And Andrew Left is saying that he reported the activities to the FBI and the SEC because when you threaten children with violence, that's it. That's where we draw the line. When you threaten somebody's spouse and children with violence, what kind of animals are you? At first, we said, oh, these are just young traders, young kids trying to make money, having fun with the stock market. Who cares? But now it has turned criminal, and we're seeing the ugly sides of these animals. I never thought in my life that I will be cheering for Wall Street. But I think I have found someone worse than Wall Streeters. These people, the Robin Hoodites on Reddit and the likes, showed their true colors. Very big mistake, and now they have attracted attention from the authorities, regulators, short sellers, and things are about to turn really, really ugly. Somebody's gonna pay the price here, not just financially. A lot of people are going to jail. And for the love of God, Wall Street, you already know what you're gonna do. You're planning to crash this market in February and March. Do it already. It's time. Things are getting out of hand. This is not a market anymore. And it's not just turning the market into a mockery. We're now verged into the territory of threatening children's lives. And ironically, some of these people on Reddit and the likes have all the qualities to become Wall Street bankers. Greed, check. Arrogance, check. Attraction to pyramid schemes, check. Lack of morality, ethics, and decency, check. My recommendation is, if you've been pumping this stock and you know that you've done it intentionally because you already had positions ahead of time, that is criminal activity. You better take your gains, bro, and hire some lawyers because you're gonna need them soon. Here is from Barron's. GameStop stock is just the latest sign of a speculative frenzy. The frantic buying of bullish call options has kept implied volatilities, the key determinant of options prices, above their actual realized volatilities. He added, usually buying put options to protect portfolios from declines pushes up implied volatility, which is most widely measured in the CBOE Volatility Index, also known as the VIX. It closed Friday at 21.91, well above the teens, where it might be expected to be, with the Nasdaq ending the holiday shortened week up over 4% and at a record, and with other averages near their peaks. Why is the VIX still trading higher? You're about to find out the hard way. More scary is the opprobrium heaped on GameStop's detractors, who have been objects of online attacks. There is a consistent stridence to major market peaks. Are you paying attention or not? A return to normalcy would be indeed welcome. We've been waiting and waiting and waiting for this mania to be over. We want a normal, functioning market once again. Are you listening, Mr. Jerome Powell of the Federal Reserve, or not? This is what you have created. And the problem with the mob on Reddit is this. The last pump was noticeable to a certain degree in the media and YouTube, etc., but not by much. You could have kept that game going for a little while. The action on Friday, the massive pump, attracted attention from everybody, specifically unwanted attention due to the criminal threats against Andrew Left. And here is the snake, Larry Summers, who I never liked, but he's saying something important here.
We had a remarkable development right at the very end of the week. It was a company named GameStop that they actually had to stop trading twice during the day. It shot way up, I mean, way up. And apparently it was because there was sort of an army of Reddit users who all marshaled together to go against a short seller. And basically, I couldn't see any change in the underlying company at all. Is social media going to really do damage not only to our political system, but to our market system?
I suspect our market system will survive social media, but God, this points up the need for, as we used to say in the Treasury in the 90s, a regulatory system as modern as the markets. And there's always a need to regulate bucket shops and to regulate various ways in which retail investors are taken advantage of. And we're in a situation where it's an old theme and an old story, but there are new ways of doing it. So I'm glad that we're having an administration and a set of financial regulators. I was glad about the appointment of people like Michael Barr at the controller of the currency, Gary Gensler at the SEC, that will be committed to regulating where regulation is necessary.
Well, Larry, briefly here at the end, I must say I'm surprised. I thought if there was going to be a regulatory body with respect to social media, it would be the FTC. It could be maybe Department of Justice and Antitrust. Maybe it'll be the SEC, actually, that has to regulate social media.
Look, I think there are a whole set of issues that are outside my expertise on, inflammatory tweets, on monopoly power in social media platforms, in privacy issues that are the FTC's remit. But when I look at things like what happened at Reddit today, that's a kind of dysfunctional market. And I think that's something the SEC is going to have to pay a lot of attention to.
And indeed, the eyes of regulators have no choice right now but to do something. And we know that the former SEC chief, Jay Clayton, was so dumb, in fact, he couldn't even order a cheeseburger correctly. His job was to wake up, brush his teeth, put a suit on, and then go back to sleep. However, the new Biden administration is trying to change the functions of the SEC and bring back its revered reputation. And right away, Biden names U.S. SEC Commissioner Allison Herron-Lee as the acting head of the regulator. So for now, we have Allison Lee, who's probably not going to do anything about it. However, here is the man who's about to lead the SEC officially, Gary Gensler of MIT. Gary Gensler, Biden's pick to head the SEC, has a reputation as a tough regulator. Financial policy experts say the unwinding of the work of his predecessor, Jay Clayton, is likely to be at the top of Gensler's to-do list. Now, Gensler wants everybody to know that there is a new cop in town, and the SEC is going to wake up from the coma it's been in the last 4 years. So he's looking for a scapegoat. He's looking for somebody to slam the handcuffs on and show the world there is a new cop in town, and this cop is not playing any games. Now, do you think that Gary Gensler is going to be tough on his former buddies at Goldman Sachs or JP Morgan, who's been rigging the commodities market? Hell no. He wants a scapegoat. And who is more perfect than these morons over at Reddit? Gensler will round up a bunch of those people, put them in handcuffs, send them to jail, and that would be the message that there is a new cop at the top of the SEC. So be careful here. The move on Friday attracted unwanted attention, meaning that the early pumpers of GameStop are gonna start to dump. So the poor kid who's saying, I'm gonna pay my student loans, be careful here. You might want to take your gains and get the hell out of that racket because it attracted unwanted attention. You guys have overdone it. And here it is. Bearish bets have remained steady, with 140% of available GameStop shares currently sold short, according to data complied by S3 Partners. Bears have seen more than 3.3 billion mark-to-market losses this year, according to the financial analytics firm. Now what? They're looking for revenge. While older existing shorts have been covering some of their positions due to a profit loss based on short squeeze, there is a queue of new short sellers wanting to get short exposure in GameStop. After its recent run-up, S3's managing director said, meaning, once again, you have attracted unwanted attention. Now there are more shorts who are looking at this as a lifetime opportunity to short, and they're going to go heavy. You're not going to be able to dwarf them this time around. And by the way, let's go back to the whole reason behind the massive run on Friday, when the mob at Reddit decided to punish, quote-unquote, punish Andrew Lift for talking negatively against GameStop. The morons on Reddit are celebrating right now with memes. All of these Robin Hoodies are having a good time, thinking that they have beat Andrew Lift and Citron. Meanwhile, the folks at Citron are laughing their asses off because you're only bloating their short target. The higher the stock goes, the better it's going to be for Citron to place a short and ride the collapse to the downside. Andrew Lift is about to get very, very rich. I mean, the guy's already rich, but he's about to get richer, shorting the stock at the top and riding the collapse to the downside. Now that the stock has attracted the authorities' attention, like I said, the early entrants will flee, causing the stock to collapse lower. And I bet Citron is watching and laughing as they place their short. And here it is, my trade that I placed on Friday. Buying the $10 puts, expiration date March 19th, and I paid about 20 cents a piece to enter this trade. My only regret is I did not buy more, because this garbage is going down and it is a shorting opportunity of a lifetime. I don't need the stock to go down all the way to $10. If it goes down 10 to 20% when the market opens on Monday, I would have already doubled my money. Of course, I want the stock to go a little higher so I can add more at cheaper prices because this baby is about to blow up. And by the way, what is Jerome Powell doing watching his so-called market functioning? This is what he's doing. He's taking his Viagra and he's whacking off to every tick higher in GameStop stock. Enjoy your market functioning, Jerome Powell. You have created an unregulated jungle in this market. Wow. Moving on to the heat map analysis, and let's see what happened on Friday. Bad day for the market overall. However, the theme is very clear here. Names that are trading in the options frenzy, the call options mania, overperform. We're talking about Apple, Palantir, Neo, AMC, GameStop, etc. But all in all, we are seeing profit taking from the market, whether it is the hot trade of semiconductors, some of the software names, the cyclical names, reopening names, inflationary trade, profit taking across the market, even in financials. Why is that? The stock market is hitting to the heat of the earnings season, trading at all-time highs. That is a recipe for disaster if corporate earnings don't live up to expectations. We saw an overperformance in the healthcare sector on Friday. The healthcare sector has one of the few pockets left in the market with decently valued stocks. We do have tailwinds here for Johnson & Johnson, Eli Lilly, due to the Alzheimer drug. You saw the name rallying higher throughout the week. Speaking of that, let's switch to the weekly picture of the heat map and see how we close the week. Once again, the inflationary trade regarding a lower dollar and higher yields retreated this week as we expected before the week even started. You see pain in banks, oil names, materials, industrials. What is outperforming? Big technology names. They're buying these stocks ahead of earnings. Outperformance from Google, Facebook, Amazon, Apple, Microsoft, the giant technology firms reporting this week. So are they making a pump and dump before earnings, or have these earnings leaked to them and they're buying ahead of time? Because once again, hitting to the earnings season with stocks trading at all-time highs is a recipe for disaster. It adds pressure on the earnings report to exceed expectations higher and higher. And what about the heat map from a weekly perspective? When we talk about the ETFs in the market, we see that technology ETFs outperforming the XLK, the VGT, yet chips ETFs, while closing in the green, lagging the broader technology sector. You take a look at the SOXX, the SOXL, closing in the green, but behind the XLK. Likewise, when we look at leverage indices, the TQQQs closing over 10.5% for the week. Meanwhile, the inverse index, the SQQQs, closing down about 10% or so. So notable outperformance here from technology this time around. The underperformance from financials and energy, whether we're talking about the XLF, the XRE, or the energy side, the XLE, XOP, all underperforming, severe declines for this week. When we shift to international ETFs, we also saw significant outperformance from Chinese ETFs, whether it is the FXI, the MCHI, which is usually the go-to for traders, all closing gains above 6% for the week. What is not performing so good this week is the Brazilian ETF, the EWZ, down almost 10% for the week. We saw declines in energy names, in material names, in commodities. Well, this is an economy that is pretty much concentrated in the inflationary trade of energy and materials. So when we see pullback in the inflationary trade, the Brazilian ETF suffers. Although the long-term outlook for the Brazilian ETF, the EWZ, is bullish overall. We also saw notable gains for the solar ETF TAN, closing over 5%. Meanwhile, the biggest decliner here is the OIH, the oil services ETF, down over 8% for the week. And this is why heed this warning. Domestic energy names, whether it's pipelines, sand oil exploration, refineries, smaller players in oil and gas, these names will suffer tremendously. And the OIH is concentrated with these names. The OIH down over 8%. Meanwhile, an ETF that has larger names, more global producers of oil and gas, such as the XLE, only down 5.5% or so. That is an illustration that the bulk of the pain in the declines in the energy sector this week came from smaller players. Moving on to the charts analysis, starting with the 15 minutes of the SPY. Gapping lower this time around, we saw a slide buy the dip attempt throughout the day. However, during the last hour, specifically the last 15 minutes of the day, we saw a massive flush down, large volume, and perhaps that is an anticipation of more policy announcements over the weekend from the incoming Biden's administration. For the first time in a long time, the risk heading to the weekend is to the downside. Now, we had a very bad closing, but did we do any technical damage to the chart and the bullish trend? The answer is, if we go to the daily chart of the continuous contract of the S&P 500, the answer is not really. All what we're doing right now, trading above the moving averages, trending above the upper limit of the channel we've been trading at. We've already retested that line of support successfully and bounced from it. All of these technical signals are bullish. We have not broken any support line. All of what we're doing right now could be consolidating in anticipation of earnings, building that bull flag formation, and then blasting higher. When do we get bearish on the SPY? A weekly close below the yellow trend line, but preferably closing the week below the very important and critical level of 3,600. Doing so will pave the way for the scenario of a 10 to 20% correction in the market overall. But for now, we remain bullish on the SPY. What about the NASDAQ, the triple Qs? Let's see what happened from a 15 minutes perspective. Anything changed? Not at all. Gapping lower, but trading flat. And for the week, after the massive gap at the start of the week, we've been trading flattish, no technical damage whatsoever. In fact, when we go to the daily chart, all what we have done through the week in the Qs is technical recovery. Matter of fact, heading into the week, we were looking at a descending line in the RSI. We were looking at a chart that broke the yellow trend line. We were showing signs of exhaustion heading into the week. And the summary of the trading week in the NASDAQ is we did a lot of repair, technical wise. Number one, fixing the negative divergence in the RSI. Number two, recapturing the trend. And all of what we're doing right now, as we discussed with the SPY, consolidating in what is called a bull flag formation in anticipation of earnings. If earnings come disappointing, watch out, because we could flush down rapidly. But all what the chart is doing right now is waiting and anticipating for the outcome of earnings. If they come better than expected, the bull flag will work and you will see the chart blasting higher. Moving on to small caps, the IWM. What do we see here? Different story. We gapped lower, but the IWM caught a bid right away, trading where? Once again, recapturing the trend line, which happens to be the upper limit of the channel we've been trading within since December. That is bullish. No ifs, no buts, no howevers. You have to take the chart as it is. What about the daily perspective in the IWM? Anything changed? Not at all. We're still trading above the channel. We are still in strength territory when it comes to the RSI. What should we watch for to turn bearish on the IWM? Here it is, a breakage in momentum in the RSI. It has been one very strong upward trend since September. Breaking that trend will signal weakness, running out of steam in small caps, and then you will witness a cascading effect of a sell-off because everybody's trying to book gains at the same time and exit the trade. But until then, the IWM remains bullish, at least from a technical perspective. What about the dollar index? We had a bull flag formation facing resistance at the level of 90.5. We broke above it. We were looking for an ABC pattern from a micro perspective right after the breakage of the bull flag. That did not happen. So the question is, are we still seeing an ABC pattern attempt from a bigger picture since the whole move started? That could be the case. And you saw the movement in the dollar index on Friday, signaling that perhaps the short covering rally is not over yet. We saw the A leg, we saw retreat in the B leg, and we're going to see a blast higher to complete the ABC leg. The momentum is still on the side of the US dollar to go higher. It could go higher if it wants to. What would derail the rally? A larger than expected stimulus bill. More spending will add pressure on the US dollar. This week we heard from Republican senators, the likes of Romney, saying that the stimulus should be smaller. This could be a negotiation tactic from the Biden administration, throwing the $2 trillion number right away and then perhaps settling somewhere in the middle. 1.3, 1.4 trillion, still a large bill, but it will be less than what dollar shorts are expecting, and they will be forced to cover. What about gold? Gold has been an excellent predictor to what's going on in the US dollar, rallying hard before the dollar goes down, collapsing violently right before we saw the massive pop in the US dollar. All what gold is doing right now is consolidating at the level of resistance of 1870. It looks like we saw a failure on Friday, but it is still not definitive because gold got bought at the end of the day. Gold could give it another shot this week, trying to blast above 1870 once and for all. But remember, what dictates the chart of gold is the movement in the US dollar, not the other way around. So if the US dollar has another leg higher, that will mean more pain for gold, perhaps retreating once again at the support level of 1800. We're watching both the dollar index and gold very, very closely. What about the TNX yields? We've been waiting and waiting and waiting, at least I've been waiting, for the B leg in yields to finally formulate. And my target is going back to the level of 1%. But remember, I've been also saying that the B leg could be a lot shorter than my target, and we could see yields blasting higher from these levels. They don't need to go all the way to 1%. Once again, what will determine the outcome of yields? The details on the new stimulus. If it is lighter than the 2 trillion the Biden administration's want, yields will go lower, because inflation expectations will retreat as well. But make no mistake that the longer-term outlook for inflation is higher, meaning that the TNX will rally higher in the long term. The question is, where is the low in the short term? My target is 1%, but it could stop short of that. Moving on to the VIX. What do we see here? We've been battling the wedge, we peaked below it, and on Friday, the VIX managed to close in the green, but we are barely hugging the lower end of the wedge, meaning that the VIX is struggling to hold on amidst all of this bullish activity in the broader market. Folks, I've been maintaining my position. If the VIX wanted to go lower to the teens once again, it would have done that a long time ago. The market had been rallying and rallying, all-time highs across the board, yet the VIX maintaining trading above the 20 handle. And the reason is all of that insanity in the options market, meaning that the VIX is saying the sustainability of the rally is not guaranteed. And there is another leg higher coming in the VIX, which will coincide with a correction in the broader market. And by the way, since we're talking about the VIX, I get a lot of messages about the UVXY. Please do not buy the UVXY if you are bullish on the VIX. The UVXY is a rat poison. It's a recipe for disaster. It's a money sinkhole. You use the UVXY if you are bearish on volatility, meaning if you're expecting volatility to decrease, then you buy puts on the UVXY. If you are bullish on the VIX, please do not buy calls on the UVXY. Take a look at what happened on Friday. The VIX, the actual VIX, was up 2.77%. The UVXY, which is supposed to be a leverage index on the VIX, was up only 1.9%. And the less volatile proxy of the VIX, my favorite, the VXX, was up 1.36%. Not so far from the highly leveraged one, the UVXY. So the question is it really worth it to take the risk with the UVXY when you can get the VXX instead? I've been trading the VIX for years. I have never made money buying the UVXY or calls on the UVXY except once, during the Brexit crisis in 2015. Other than that, I lost money every single time. The one that works for me is the VXX. And here is the weekly chart for the VXX, and let's see what's going on. We have a descending line of resistance. We hit it once, we failed. Twice, third time, fourth time. The question is fifth time a charm or what? I think so. And you saw the options trade on the VXX during the options market coverage. I think that the VXX will break out at this point along with the broader volatility index. Moving on to Apple. What do we see here in Apple? Remember what I usually say. As Apple goes, so will the NASDAQ. And matter of fact, so will the market altogether. We have been seeing in Apple since the correction in September is a series of lower lows, and the chart managed to make all-time highs once again. The problem is the traders are buying the name ahead of earnings. And the question is, did earnings leak? Do they have earnings ahead of time and they know it's good and the market will react positively to those numbers? Or are they just speculating after they saw the action in Netflix and they decided to buy all of these big tech names ahead of time, expecting that Apple numbers will live to expectations? That is a very dangerous game to play. It is playing with fire, because if results do not meet expectations, specifically the high expectations from the stock price right now, the stock could crash violently. We will talk more about options, strategies heading into the week for Apple during the earnings week coverage tomorrow. And here is the last chart of the day for Tesla. Once again, receding volume in options as well, leading to Tesla being flat, slightly to the downside. We have earnings coming up next week. Are they going to buy Tesla ahead of earnings? The stock is trading at all-time highs. It's very expensive. The options are absolutely insane in terms of high premiums. There's no way retail traders will be able to afford buying call options ahead of time. So the mood right now in Tesla stock is, let's wait and see what happens after earnings. My call is that earnings are not going to lift to expectations, and we will see the name sliding down to revisit where? The upper limit of the channel, where we broke from. And that would be about 10 to 15% correction from where we are right now. And of course, traders are waiting for the dip to do what? To buy it once again. Specifically, if we see the dip and then we see a new round of the steamy money, that steamy money will go into buying the dip in Tesla shares. And lastly, let's move on to conclude this video. What do we have on the economic calendar next week? On Tuesday, we have the Consumer Confidence Index. That will be very important. On Wednesday, we have durable goods, and we have Jerome Powell, your favorite, speaking. What is he going to say? Is he going to slip? We know that every time Jerome opens his mouth, he tries to prop up the market, but he does the opposite, and the market slides lower anyways, because Jerome cannot escape the facts. If you ask him the right questions, such as, what is the exit strategy? Jerome will become nervous and he will ask you not to ask him questions about exit strategy because the markets are listening. Yeah, Jerome, if the markets are listening and they sense that you are bullshitting, you're not a good poker player, the market will slide lower. Anyways, what do we have on Thursday? The typical jobless claims, the weekly jobless claims. We have new home sales and leading economic indicators. That would be very important to watch for. But the big kahuna here is the GDP number. Why is that important? We know that the excess money supply in the system will lead to a very high inflation. The reason why inflation hasn't picked up to the magnitude of where money supply is due to the velocity of money. We're not seeing the velocity of money in the economy picking up, but the GDP number will give us a clear indication of where money velocity is heading. If the GDP number comes up higher, that means that we're seeing an uptick in money velocity in the economy. That means that inflation will surge higher. Once again, bad news is good news for the stock market, but good news is actually bad because it will signal an upcoming inflation, perhaps higher than expectation, which will lead Treasury yields higher, and that in turn will force us to cut multiples across the stock market. And finally, what do we have on Friday? We have personal income, consumer spending, core inflation right away. We have the Chicago PMI. That will be very, very important. And the Consumer Sentiment Index. This is the final reading. We had the initial reading the beginning of the month. Now we're going to have the final reading. Once again, this could not be a more important week for the market. The biggest earnings coming up and very important critical economic numbers. Thank you for being with me throughout this long ride in this video. I appreciate your viewership, your subscription, clicking the like button. I look forward to talk to you again very soon.